The whole system's going to collapse, and none of us own enough cash for what's about to happen.
Man, that is quite the hook to start with.
Right. And that isn't just some wild Reddit doomsday post. That is a direct warning from Tavi Costa.
Yeah, one of the most respected macroeconomists in institutional finance, honestly.
Exactly. He's the co-founder of Azura Capital. And today we are doing a deep dive into the math behind that exact warning.
It's a sobering perspective for sure, but I mean, it's a fundamentally analytical one.
Yeah, he's not just fear-mongering here.
No, not at all. He is looking at historical precedent, structural market shifts, and just the raw, unmanipulated data of global capital flows.
So that's our mission for this deep dive. We are looking past the daily market noise, right? We want to understand the tectonic plates that are shifting underneath everything.
Right, the stuff that's actually moving the needle.
Exactly. So we're going to dissect the real story behind inflation metrics, the ticking time bomb of U.S. sovereign debt, and how geopolitical spending is just pushing the whole fiscal system to a breaking point.
And I think the most important part is exploring why some of the absolute smartest money in the room is rapidly abandoning traditional tech investments.
Yeah, that massive rotation into hard assets, copper, gold, and this really surprising shift into emerging markets.
Which, I mean, that requires a total mental pivot for anyone who has invested in the markets over the last, 10 or 15 years.
Oh, absolutely. So for you listening, we're framing this conversation not as some survivalist bunker briefing, but really as a masterclass in reading between the lines of global finance.
Yeah, it's about protecting and growing your wealth in a totally new regime.
So let's just jump right in. We have to start with the data that's currently driving every major decision in global markets right now, which is inflation.
Or, I guess you could say, the illusion that inflation has been tamed.
Right, exactly. Because the official narrative from central banks right now is just overwhelmingly comforting.
Oh, yeah, everything is fine. Look at the PPI, right? The Producer Price Index.
Yeah, which measures wholesale prices before they hit the consumer.
Right, and recently, the PPI for goods actually showed a 1.4% drop.
And the overall month-over-month PPI for June was, what, negative 0.3%?
Exactly. So officially, we are looking at disinflation or even outright deflation in certain sectors.
Which paints this picture of the Federal Reserve just totally nailing the soft landing. You've got guys like former Fed Governor Kevin Walsh testifying before Congress, preaching fiscal discipline.
Yeah, and reinforcing that classical academic view that long-term inflation is strictly a monetary phenomenon.
Right, like if the money supply shrinks and wholesale prices drop, then hey, we killed the inflation dragon.
It's very technocratic, like they just pull a lever and the machine obeys.
But, and this is where it gets interesting, Tavi Costa violently disagrees with this whole premise.
Oh yeah, he calls the government data a complete joke.
A total joke.
Hmm.
Because his core argument is that real inflation, like what you and I actually pay at the grocery store or for property insurance or just basic services, is massively higher today than it was 5 years ago.
And it is definitely not dropping.
No. I mean, I love Costa's analogy here. It feels like driving a car with a broken speedometer.
Yeah, the government just sitting in the passenger seat, tapping the glass like, look, we're only going 30 miles an hour.
Right. But you look out the window and the trees are just blurring past you at 90.
Exactly. And that divergence between the dashboard and the window
Yeah.
is really the root of Costa's entire thesis.
So why is there such a massive gap? If everyday life feels so incredibly expensive to you, how is the data saying otherwise?
Well, Costa suggests we aren't just looking at, a margin of error here. It's a systemic, incentivized manipulation of how inflation is actually measured.
Because the governments have a massive financial incentive to change the rules, right?
Oh, absolutely. Especially heavily indebted ones. They change the definitions to serve their own policy goals.
Okay, so let's unpack the mechanics of that. When you say they change the definitions, how does the Bureau of Labor Statistics actually massage that number?
Well, it happens through these little methodological tweaks over decades. One of the biggest ones is called hedonic adjustments.
Hedonic adjustments. Break that down for us.
So the BLS basically argues that if a product improves in quality, any price increase shouldn't fully count as inflation because you're theoretically getting more for your money.
Okay, let's ground that in a tangible scenario, like a car or something.
Yeah, a pickup truck is a perfect example. Say in 2019, a standard truck cost $30,000.
Okay.
Today, the newer model of that exact same truck costs $45,000.
So for the consumer, that's just a raw $15,000 increase to get a car.
Right. But the BLS applies a hedonic adjustment. They say, well, this new truck has a much better infotainment screen, better safety sensors, maybe a better transmission.
And they just assign a dollar value to those upgrades.
Exactly. They might say, on paper, those upgrades are worth $14,000. So in the official CPI calculation, the price of the truck only went up by $1,000.
Wait, not 15,000?
Nope, only 1,000. The inflation is just statistically erased.
Even though your bank account is still drained of an extra 15 grand if you want to buy the truck.
Exactly. And they apply this to everything. Appliances, housing, you name it.
That is wild. And then there's the substitution effect too, right?
Yeah, substitution is another massive lever they pull. So CPI is based on a basket of goods.
Right.
Historically, that basket was pretty fixed to measure the changing cost of a static standard of living. But they changed the methodology to assume that you, the consumer, are just going to substitute cheaper items if prices rise.
So if the price of steak doubles, they just assume you stop buying steak.
Exactly. They assume you start buying ground beef. And if ground beef gets too expensive, they swap it for chicken in the index.
So the index doesn't actually measure the cost of maintaining your standard of living at all.
No, it measures the cost of a continuously declining standard of living.
That's incredible. By substituting steak for chicken, the official inflation number stays artificially low. But your actual purchasing power, your ability to buy that steak you used to easily afford, is just gone.
Right. And Costa argues this manipulation is peaking right now because they need the data to look benign.
Because they need an excuse to lower interest rates.
Or at least to stop raising them, yeah. Because if the Fed actually acknowledged real inflation, that 90 miles an hour you're seeing out the window, they'd have to act on it.
They'd be bound by their own mandate to crush it.
Exactly. And Costa speculates that if they used unmanipulated data, based on how the Fed reacted in the past, they would need to raise interest rates to 10 or even 15%.
Okay, a 15% Fed funds rate. That is, that's a staggering number today.
It's fathomable.
Oh, wait, let me push back on this for a second because we do have historical precedent for this. Paul Volcker raised rates to nearly 20% in the early 80s to break inflation, and the government didn't collapse.
Right, we had a severe recession, but the system survived.
Exactly. So what has fundamentally changed in the math between 1980 and 2026 that makes a 15% rate a death sentence now?
It's the denominator. The denominator completely changed.
The total debt.
Yeah. In the early 80s, the total U.S. national debt was around $1 trillion. The debt to GDP ratio was maybe 30%.
So the government had almost no leverage, relatively speaking.
Exactly. But today, the national debt is approaching $35 trillion. The debt to GDP is over 120%.
Wow. So the sheer volume of the principal just makes the interest payments completely destructive.
Right. When you owe $1 trillion, a 15% interest rate hurts, but you can manage it. When you owe $35 trillion,
the math just breaks.
It does. A 15% interest rate on that much debt requires more capital to just service the interest than the entire U.S. economy generates in tax revenue.
That's terrifying. The system is barely functioning right now with rates around, 3.75%?
Exactly. So a 15% rate today wouldn't just cause a recession. It would cause an immediate catastrophic systemic collapse.
Right. The housing market would instantly freeze. A 30-year mortgage would be, 17, 18%?
At least. And businesses couldn't borrow, so mass layoffs.
Yeah.
But the scariest part is it would fundamentally bankrupt the United States government.
They would straight up default on their interest payments.
Yeah. Which means the Federal Reserve is completely trapped. It's an impossible dilemma.
They either fight real inflation and mathematically destroy the system, or they let inflation run hot, destroy the currency, and hide it with tweaked CPI data.
That is exactly the box they are in. And this perfectly transitions into the core structural vulnerability holding them hostage, which is the mechanics of the U.S. sovereign debt itself.
Right, because Costa points out that the debt isn't just some abstract number on a website anymore. It is actively dictating how the country operates.
Oh, absolutely. Right now, the U.S. economy literally has to grow at 4 to 5% annually just to generate enough tax revenue to pay down the debt.
Think about that. We have to grow the GDP of the world's largest economy by 5%, not to build new bridges or innovate, but just to tread water on past borrowing.
It's a massive drag on economic velocity. And it's getting so much more precarious because of the maturity wall we are hitting right now.
The maturity wall, you're talking about rolling over the debt.
Yes. Between 25 and 33% of the entire U.S. sovereign debt needs to be rolled over in the next 12 months.
Okay, let's clarify what rolling over actually means. Because I think people view the national debt like a credit card where you just make a minimum payment.
Yeah, that's not how it works. It's as much closer to like an adjustable rate mortgage.
Okay, so when a sovereign bond matures, the government doesn't just open a vault and hand over the cash to pay off the principal?
No, they issue brand new bonds to investors to pay off the old ones. They refinance it.
Right.
And the critical danger right now is the interest rate differential. A huge chunk of this debt that's maturing over the next year was issued years ago,
Yeah.
back when we had zero interest rate policy.
So the government was paying maybe 1 or 1.5% interest on that money.
Exactly. But now that 0% teaser rate is expiring, the mortgage is resetting,
So when they roll it over today, they have to refinance it at current market rates.
which are significantly higher. They are refinancing trillions of dollars of 1% debt into 4 or 5% debt.
The principal amount hasn't even changed, but the cost to hold it just exploded overnight.
Exactly. And this creates what economists call the crowding out effect.
Right, because as that interest expense becomes this massive expanding slice of the federal budget, the fiscal pie, it physically crowds out everything else.
There's simply less money for infrastructure, healthcare, education, everything.
And crucially, it restricts the nation's ability to manage global crises. Costa specifically points to the escalating geopolitical situation, right? Like the potential for a prolonged conflict with Iran.
Yeah. And I think we need to make a really clear distinction here for the listener.
Yes, absolutely. Costa is very explicit that his analysis here is not a political commentary. He's not arguing whether a military engagement with Iran is morally justified or strategically right.
And neither are we. We aren't taking a stance on the ethics of the war at all.
Right. He is looking at this purely as a macroeconomist looking at a balance sheet. His argument is just math. The United States physically cannot afford to fund a new, massive overseas conflict.
Because wars are inherently inflationary. They require immediate massive deficit spending. They disrupt global supply chains.
And they pull industrial capacity away from consumer goods. The U.S. is trying to be the global police force while its domestic fiscal house is just falling apart.
And, despite all the political promises of fiscal discipline over the years, like Costa brings up that DOGE initiative from a couple of years ago that promised radical spending cuts.
Right, the Department of Government Efficiency stuff.
Yeah, but the objective reality is that deficit spending has only accelerated.
Yeah.
The political will to actually enact austerity just doesn't exist.
Which leads to a symptom in the financial markets that Costa says is truly alarming. He says the U.S. Treasury market is acting like an emerging market.
Yeah, that is a foundational crack in the system. Because U.S. Treasuries are supposed to be the bedrock of the entire global financial architecture.
Right. They are literally the textbook definition of a risk-free asset.
Exactly. When a global bank needs collateral for an overnight loan, they use treasuries. When a foreign central bank stores its wealth, it buys treasuries.
The whole plumbing of global finance assumes U.S. debt is perfectly stable and liquid.
But when that bedrock collateral starts experiencing violent price swings, volatility like a developing nation going through a currency crisis,
Every single institution built on top of it is at risk.
the margin calls and instability ripple out instantly.
But wait, if you look at a chart of the U.S. dollar right now, the DXY, it paints a totally different picture.
It does look strong on the chart, yeah.
Right. It looks incredibly strong against major currencies. So if the fiscal situation is so bad, why is the dollar flexing its muscles globally?
Costa points out that this strength is basically a short-term illusion that's masking a terminal illness.
How so?
You have to remember what the DXY actually measures. It doesn't measure your purchasing power at the grocery store. It measures the dollar against a basket of other heavily indebted fiat currencies.
Like the euro and the yen.
Right. So it's essentially just the cleanest shirt in a very dirty laundry basket.
I love that analogy.
Yeah. But fundamentally, the dollar is suffering from the twin deficit problem.
Okay, let's dive into the twin deficits. Fiscal and trade. This requires looking at the country kind of like a corporation, right?
It's exactly. If the U.S. is a company, it has two main ways to make net revenue. Domestically, it can collect more in taxes than it spends. That's a fiscal surplus.
Which we definitely do not have.
Right. And internationally, it can export more goods than it imports. That's a trade surplus.
And we don't have that either. We are bleeding staggering amounts of capital on both fronts. We're running massive double-digit deficits in our budget and our trade balance.
We operate at a massive loss every single year and just compound debt to cover it.
And here is where the currency valuation comes in. A strong dollar is actively terrible for a nation running a massive trade deficit.
Oh, it's brutal. When the dollar is strong, American-made goods become way too expensive for foreign buyers.
Right, a tractor built in Illinois is suddenly too expensive for a farmer in Brazil because the exchange rate punishes them.
While at the same time, foreign imports become artificially cheap for Americans, which just widens the trade deficit even more and kills domestic manufacturing.
So, to actually fix the trade imbalance and make exports competitive again, the dollar fundamentally must be severely devalued.
It is a mathematical inevitability. They have to inflate the debt away by debasing the currency.
And you have to think about what that means for you, the listener, and the money sitting in your savings account.
Yeah, if the global economy dictates that the dollar must devalue, the purchasing power of your life savings is actively being engineered to decrease.
The numbers in your bank app might stay the same, but the physical reality of what those numbers can buy is designed to shrink.
Exactly. Which brings us to the most critical action item of Costa's whole thesis.
Right. If the Fed is trapped, inflation is uncontained, the treasury market is volatile, and the dollar has to devalue. Where does the smart institutional capital actually go to survive?
And this is the catalyst for a massive generational shift that's happening right now. The great rotation away from U.S. tech stocks.
Yes. Costa is super emphatic about this. He explicitly warns people against rotating back into tech, calling it overbought and dangerously concentrated.
It's totally mispriced for the reality of the next decade.
But I have to pause and channel the listener's incredulity here.
Yeah.
Because for the last 15 years, U.S. tech has been the only trade that mattered.
It really has.
We are constantly told about America's insurmountable lead in AI, software, you name it. Are we really supposed to abandon the most innovative sector on Earth just because the valuation is a bit stretched?
It's a deeply ingrained reflex to buy the tech dip. But Costa is pointing to a structural shift in the global labor market that people are ignoring.
Right, the historical moat.
Yeah. Historically, the U.S. had this incredible advantage because it attracted all the world's best brains. Silicon Valley consolidated the talent.
And Costa is arguing that moat is being dismantled.
It's being bridged by the very technology Silicon Valley built. AI is rapidly narrowing the global labor gap.
Okay, give me an example of how that works in practice.
Well, 10 years ago, you paid a huge premium for a senior software engineer in San Francisco because they could write code at a speed and level that someone in an emerging market just couldn't match. But today, with AI coding assistance and global cloud infrastructure, a talent pool in Warsaw or São Paulo can produce highly complex enterprise software at a fraction of the cost.
Because the technology democratized the output. The physical location of the brain matters way less when the AI tool amplifies everyone's baseline capability to almost parity.
Exactly. So the immense competitive advantage U.S. tech had is shrinking, but their stock prices are still trading at astronomical multiples.
So to be clear, he isn't predicting the death of U.S. tech.
No, not at all. The U.S. still has deep capital markets, the rule of law, and AI leadership.
But the mega-cap valuations are priced for total, unending global dominance. They haven't adjusted to the fact that the competitive gap is actually narrowing.
Right. And because the Treasury market, the collateral they rely on for cheap borrowing, is shaking, institutional capital is being forced to look elsewhere.
Costa believes we're entering a 5 to 10-year cyclical era where market leadership aggressively rotates away from U.S. paper assets and flows into hard assets.
Tangible resources, the stuff required to actually build physical civilization.
Things you can drop on your foot. So if smart money is fleeing software, where is it landing? Let's talk about the physical metal ironically required to power the AI revolution: copper.
Copper is undergoing an historic metamorphosis right now. For decades, Wall Street called it Dr. Copper, the ultimate economic thermometer.
Right, because it's used in cars, houses, electronics. If the economy was building, copper went up. If we hit a recession, copper went down.
And it was usually highly correlated with other macro indicators, like gold. But Costa points out a massive divergence happening. Copper is decoupling from gold.
And surprisingly, it's trading more in line with the S&P 500. Why is a base metal acting like a tech index?
Because it's shifting from an economic thermometer to an asset driven by severe structural supply and demand imbalances. It's the primary bottleneck for the future economy.
So let's break down the demand shock. It's not just about building more houses anymore.
Not at all. It's an unprecedented rewiring of global energy and data infrastructure. Think about the footprint of AI. Tech giants are building billion-dollar gigawatt data centers.
And those require miles of high-density copper wiring for power, server racks, liquid cooling systems.
Exactly. Plus, the geopolitical push to onshore manufacturing back to North America requires entirely new industrial grids.
And EVs. An electric vehicle requires up to 4 times as much physical copper as a traditional gas car. The charging networks alone need thousands of tons of it.
So demand is going parabolic. But the supply side is incredibly constrained. You can't just flip a switch and open a copper mine.
The capital required is staggering. And the time, right.
It takes decades. From discovery to environmental permitting to actually building the processing plant, it can take 15 to 20 years to bring a Tier 1 copper mine into production.
Because the industry underinvested in exploration for the last decade while all the capital chased tech returns.
Exactly. And this structural deficit is why billionaire Robert Friedland recently called copper the new safe haven.
That is a radical reclassification. You usually reserve safe haven for treasuries or physical gold. Calling a volatile industrial metal a safe haven is wild.
But it fits the data. Costa uses this incredibly vivid analogy to describe copper's price action right now. He compares it to holding an inflated beach ball underwater.
I love this one.
Yeah, the macro fears like looming recession worries or high interest rates dampening construction are acting like hands pushing down from the surface, trying to force copper lower.
But the fundamental reality of the AI data center demand and the supply deficit is creating this massive buoyancy, just forcing the price back up against the pressure.
That refusal to break down is exactly what technical analysts look for. It's a massive, bullish signal of accumulation by strong hands.
And historically, when a constrained metal breaches that resistance, it doesn't just inch past its old highs, it explodes.
Yeah, look at silver in the late 70s, jumping from $4 to nearly $50, or gold blowing past 2,000. Copper hasn't had that vertical move yet.
The beach ball is still underwater, but it's about to violently breach the surface. And while tech giants stockpile copper, central banks and sovereign wealth funds are quietly stockpiling a totally different metal to survive the fiat crisis we talked about: gold.
This is where market psychology gets tricky, and retail investors often get washed out. Recently, gold had a brutal 25% drop, from over 5,000 down to roughly 4,000 an ounce.
And the financial press narrative was perfectly synchronized. Everyone said fears of the Iran conflict would spike oil, cause secondary inflation, and force the Fed to keep rates high.
Right, and when rates are high, the opportunity cost of holding non-yielding gold goes up, so investors dump it for yielding bonds.
The institutional reaction was so swift, Bank of America aggressively cut its gold forecast down to $4,360.
And the media just amplified the panic.
I saw a Wall Street Journal article profiling an 83-year-old retired financial advisor who liquidated his lifetime gold position, just expressing immense relief that he got out before it crashed further.
Textbook capitulation. The banks issue a downgrade, retail panics at the bottom, and media writes the obituary.
But Costa looks at that exact same 25% plunge and calls it a massive generational accumulation phase. He is wildly bullish.
And if you look at the mining stocks, the companies actually pulling it out of the ground, they are devastated. Take Agnico Eagle, a premier senior producer, down 44%.
Okay, we need to explain this mining equity disconnect. Why is a highly profitable gold miner down 44% when the metal itself is still historically robust at 4,000 an ounce?
It comes down to cost inflation. Running a mine is massively energy and labor intensive.
Right, diesel fuel for the haul trucks, steel for the grinding mills.
Exactly. Over the last 3 years, all those costs skyrocketed. So while gold went up, the cost to extract it went up almost as fast, squeezing their profit margins.
But Costa argues the market drastically overpunished them. These companies are pumping out massive free cash flow, but they're priced as if gold were way below 3,000 an ounce.
It's a profound disconnect. But Costa points to a specific internal metric in the mining sector that gives him absolute confidence this isn't the end of the run.
The relationship between the seniors and the explorers. Let's break this down. It's fascinating.
So in mining equities, you have seniors, massive producers like Newmont or Agnico with operating mines and dividends. They're the blue chips.
Relatively safe.
Right. And then you have the explorers or juniors.
Yeah.
Microcap, highly speculative companies. No mine, just a plot of land and a drill rig hoping to strike a discovery.
The riskiest assets in a risky sector.
Typically, at the end of a bubble, capital flees the speculative explorers first in a total panic and hides in the seniors. But right now, Costa notes the explorers are actually outperforming the seniors.
Which means the underlying appetite for risk hasn't evaporated at all.
Precisely. Historically, that signals we are in the middle of a secular bull cycle, not the end. The market is just taking a cyclical breath.
I have to challenge this optimism again, though. If Beauvais is cutting targets and veterans in the WSJ are liquidating, how can Costa be so sure this is a buying opportunity?
Well, you have to ask yourself, did the fundamental macroeconomic thesis change, or did the asset just get cheaper? The retail panic is a knee-jerk reaction to short-term rates.
But the structural reality, the trapped Fed, unpayable debt, dollar devaluation, hasn't changed one bit.
If anything, the debt clock is ticking faster. The thesis is totally intact. The weak hands just got shaken out. To really understand gold's utility here, Costa points back to the 1940s.
The post-World War II.
Yeah. The U.S. had a debt-to-GDP ratio very similar to today. Do you know how much of the U.S. Treasury market was backed by physical gold in the 1940s?
I'm guessing way higher than today's fractional reserves.
50%. Half the entire Treasury market was backed by gold. The debt was anchored to reality. Today, with arguably worse structural debt, that number is only 3%.
3%, the leverage is insane.
Sovereign wealth funds and central banks look at that 3% backing. They look at how the U.S. weaponizes the dollar, and they realize they are unacceptably overexposed to unbacked fiat.
They mathematically must accumulate gold to anchor their own balance sheets. Right. It's not retail day traders. It's sovereign restructuring at the highest level.
And a big argument against gold historically, which the WSJP's mentioned, is that it doesn't pay a dividend. It just sits in a vault costing you storage fees.
The opportunity cost argument.
Exactly. But the infrastructure is evolving. Companies like Monetary Metals, who actually sponsor some of these financial deep dives, have created platforms where you can lease your physical gold to industrial users.
And earn a yield on it.
Right. You can earn up to a 4% annual yield paid in additional ounces of physical gold. So that old academic argument is being actively dismantled by free market innovation.
It perfectly shows how the ecosystem is adapting for this new hard asset era.
So if institutional capital is rotating into hard assets, copper for AI, gold for monetary survival, the next question is geographic. Where are these resources?
And this pivots to the most surprising part of Costa's thesis: the impending Latin American Renaissance. Costa is adamant that to get the hard asset trade right, you have to get the emerging markets trade right. And the data from Latin America is quietly turning heads.
Over the last 5 years, despite all the global noise, Latin American currencies, specifically Peru, Mexico, and Brazil, have been the best performing currencies in the world.
Actively beating the euro and the yen, which flies in the face of the Wall Street narrative that EM currencies are always hyperinflationary and fragile.
It shatters the narrative completely. And Costa attributes it to a few things. First, Latin America is incredibly resource-dense and highly unexplored geologically.
Second, they're actually eager to partner with foreign resource businesses, unlike North America, where permitting a mine is almost impossible.
And third, there is a major structural political shift toward capitalism, fiscal discipline, and market-friendly policies across the region.
While the developed world moves backward into debt traps, they are moving forward. Costa uses a great Wayne Gretzky analogy. You don't skate to where the puck is, you skate to where it's going.
Right? Latin America isn't perfect today, but the net change is moving in a highly positive, pro-business direction.
And investors can play this without buying obscure foreign stocks. Costa uses the Chile ETF, ticker ECH, as a prime backdoor strategy.
Chile is the Saudi Arabia of copper. But interestingly, the ECH holds very little direct mining stock.
Which is wild. If they are the king of copper, why isn't the national ETF full of miners?
Because the massive mines are owned by multinationals based in Canada or Australia. The local exchange isn't dominated by the miners. But the ETF still acts as a leveraged proxy for copper prices.
How does that work?
Because the entire domestic economy is tethered to copper wealth. When copper goes up 20%, mines expand, hire more locals at higher wages.
Those workers put money in local banks, buy real estate, spend at retail stores.
Exactly. The government collects royalties and builds infrastructure. So the local banks and consumer stocks in the ETF soar. It's a backdoor play on the economic ripple effect of the commodity boom.
That is fascinating. And his strategy applies to energy, too, using cyclical trading. He actively sold oil when it was euphoric above $100, rotated into out-of-favor copper, and now...
Now, with oil sitting quietly around $80, he's looking to buy back in. He's even trying to form a private energy company. Sell the euphoria by the trough.
And if we look at historical cyclicality, this Latin American thesis has massive precedent. Look at the early 2000s commodity supercycle.
After the dot-com bust, when capital fled U.S. tech, the parallels are striking.
If an investor back then did nothing but buy and hold the broad, boring Brazilian stock index, the Ibovespa,
They would have seen an 18 times return on their money by 2011.
an 18x return on a broad national index. But Costa makes a crucial distinction. You can't just buy a broad EM fund today and win. You have to be surgical.
Yes, you must actively avoid commodity importers, like China. When raw material prices surge, their profit margins are destroyed.
And you must avoid authoritarian regimes like Russia because capital refuses to go there due to sanctions and lack of rule of law.
The absolute bullseye is commodity producers in market-friendly, democratic jurisdictions, which points squarely at Latin America.
Okay, we have covered so much ground here. Let's synthesize this because it's daunting but incredibly actionable.
Let's trace the causality from the top.
We have a Federal Reserve trapped by a mathematically unpayable mountain of sovereign debt. They can't raise rates to fight real inflation without instantly collapsing the government's ability to service its debt.
So their only mathematical way out is to inflate the debt away by severely devaluing the U.S. dollar.
And because of these massive macro forces, institutional capital is waking up. They realize U.S. tech valuations are priced for a monopoly right when AI is destroying their labor moat.
So that capital is structurally fleeing paper assets and rotating aggressively into hard assets, copper to build the AI infrastructure, and physical gold for sovereign monetary survival.
And geographically, this rotation points toward a massive economic renaissance in resource-rich, capitalism-curious emerging markets like Latin America.
It's a complete inversion of the 2010 to 2024 playbook. The winners of the last cycle are positioned to be the losers of the next.
It requires an entirely new framework for risk. You just can't use the map of the 2010s to navigate the late 2020s.
You really can't.
And frankly, it forces us to confront a really uncomfortable question. If traditional data like the CPI can't be trusted, and supposedly risk-free U.S. Treasuries are trading with the volatility of an emerging market.
It forces us to question the yardstick itself.
Exactly. If you measure your wealth, your savings, your security purely in fiat dollars, are you actually measuring anything real at all? Or is the ruler stretching out longer every single day?
As we enter a decade defined by hard assets, it really might be time to completely redefine what money actually is.
That is the ultimate question this cycle is going to answer for all of us, whether we are prepared for it or not. Keep questioning the consensus. We'll catch you on the next deep dive.